Okay.
Are you with me?
Yes.
Okay, start. Yeah, they said Maya provides, answer all these questions. Okay, they said Maya provided the following information at 1 January 2019. We have the bank, which is a credit there. We have the bank, which is a credit. We have fixtures and fittings. We have inventory, other receivables, trade payables, and trade receivables. The first question says calculate equity. To calculate equity, equity is calculated as your assets minus your liabilities. Are you with me? Yeah, so equity is what? Assets minus liabilities. So if assets is asset minus liability gives us equity, we need to find the assets and the liabilities. But let's go down. Maybe we have additional information. Yeah, there are other information, additional information, but I don't think we need them now. So let's go back to the first question. So these are the items we have for the financial records of Maya. So first we have to find the assets. So the assets are fixtures and fittings an asset. Fixtures and fittings, that's 48,000. Fixtures and fittings, 48,000 plus inventory is an asset, that's 20,000. Hold on, please. For the fixtures and fittings, we have the cost of at 60,000, right?
Where?
There's costs at 60,000.
I don't. Wait, can I just go bring my calculator?
Don't worry about the calculator. It's okay. I have my calculator here. What I'm saying is the item fixtures and fittings. You see, cost $60,000 there, right? But we're not going to use that value. We're going to use the net present value, which is 48,000. So the first asset we have is fixtures and fittings, which is 48,000 plus. Are you with me, please? So we have 48,000 plus inventory. We're talking about the stock of the business, 20,000 plus other receivables, 1,100. When we talk about other receivables, we're talking about what the customers are owing the business. That is other receivables. I'm going to write the note for you anyway.
Okay.
Yeah, we have 1,100. Then the last one we have is trade receivables, which is 40,000. So this is the total of all assets, which is 109,100. Can you see my calculator?
No, I can't.
Oh, okay. Okay, you can just get your calculator so we can do it together.
Okay, I will.
All right.
I have it now.
Okay, let's do it together again. We said equity is assets minus liabilities. Our assets here are fixtures and fittings, 48,000.
48,000.
That's
plus.
Okay, plus inventory, 20,000. Plus other receivables, 1,100. Then trade receivables, 40,000. So the total of assets are 109,100. Is it?
Oh, yeah. What about the trade payables?
It's a liability. Those are your credit suppliers. They are your credit supplier. It's a liability. We said asset minus liability gives you capital or equity. So now for your total liabilities, we have the first liability you have here is bank. No, yeah, the total liabilities you have the bank, which is 5,750. Are you there?
Where?
Yes, 5,750.
Yeah, 5,000. I see.
With credit, yes. Plus trade payables, 34,950. That gives us 40,700.
5,750.
Yeah.
Plus
950.
950. 40,000. Is that? Are we gonna like?
40,700. 40,700, right?
Yes.
All right. So your equity, we are told to find equity, right? So equity will be
Mhm.
calculated as total assets minus total liabilities. So we have 109,000 109,100 minus 40,700. So that gives you 68,400. Is it clear?
Mhm.
That's your total equity. Any question about that's your equity? Any question about it?
No.
All right. So that's equity. Then we go on to question B. So before I go to question B, there are additional information. They said during the year ended 31 December 2019. Meanwhile, the equity you have now is for the January 1, 2019 equity, okay?
Mhm.
All right. Now we have additional information. They said sales were $210,000. Purchases were 155,000. Maya took 3,000 in goods and 15,115 in cash for personal use. In goods, that is goods for own use. In cash, that is drawings. Put that in your mind. For the goods, we call it goods for own use. In cash, we call it drawings.
Mhm.
So those of goods, you less it from your cost of sales. And the total for both will be, you take both, the total for both to your statement of financial position. But when you get there, when I get there, I will let you know.
Mhm.
For the goods, you use it in your income statement. For the amount Maya took, like the amount of goods she took from her own business for personal use, you less it from your cost of sales. When I'm preparing the income statement, you get to understand, don't worry. Okay?
Okay.
All right.
Mhm.
So these are the additional informations we have. Then they said Maya introduced a private motor vehicle valued at $10,000. That's capital introduced. So that's additional equity. We call it additional equity, okay?
Mhm.
All right. Then the last thing there is profit for the year as a percentage of revenue. So they said the profit made by Maya is 10% of the sales. That means 10% of 210,000 is the profit made. Is that clear?
Uh-huh.
Yeah, then we have December 31, 2019, the inventory was valued at $25,000. That is the closing inventory.
Mhm.
Now, we are told to prepare income statement for Maya. So for your income statement, you write, they wrote it already, income statement for the year ended 31 December 2019. So you use a tabular form where you have your debit and the credit. Okay?
Mhm.
All right. So what you do with that, hold on, please. Let me see if I can try over here. No. Okay. Let's see if you can draw a table. Okay. So we're going to have a table drawn. We're going to have a table drawn. Though it's not going to, yeah, but I just have to let you know. It's okay. We're just going to draw it somehow. Then we have the text. So here you're going to put, oh, I doubt it. Your revenue, then the amount of revenue. The revenue, the amount is 210,000, 210,000, 210,000. Then that's for revenue.
Mhm.
You take it to your credit side. I don't know how to put it here. Let's see. Okay, hold on, please. Let's see if I can. You have revenue. So for revenue, write revenue here. Erase it. Let's see if I can. Let me try. So okay, for revenue, you write 210,000.
Mhm.
210,000. Then you have your less cost of sales, less cost of sales, less cost of sales. The cost of sales, now we have the first one we have for the cost of sales, you have your opening inventory.
Mm-hmm.
Let me see if we can. We have opening inventory, opening inventory. You have opening inventory, the value, but I need the values. It's right, okay. Opening inventory. I need to get the values. It's gonna be like. Okay, let me just explain it. So because
Okay, explain it.
yeah, this is just gonna take much of our time.
Mm-hmm.
No way. Yeah, because we need here. All right. For the opening inventory, so you're gonna have the first thing you do is this. You have your revenue on the credit side. You have the debit side. You have the credit side, right?
Mm-hmm.
Yeah.
Yes.
On the debit side, you leave on the credit side first. You start with revenue. On the credit side, you write your revenue, which is 210,000. Then you less your cost of sales. Note, your cost of sales minus your revenue gives you your gross profit. So when you are preparing an income statement, the values you're going to put are the ones we have here, the items. So the first one is revenue, which is 210,000. Then we go on to our opening inventory. The opening inventory is 20,000. You put it on the debit side.
Mm-hmm.
Are you with me? Then
Yes.
receivables, payables, these are all in the statement of financial position. You don't need them now. The only thing you need here is the inventory. So the other informations, we have them at the bottom here. So your purchases is 155,000. So you write opening inventory. For your opening inventory, we have 20,000 written. Then your purchases, which is 155,000, you add it to your opening inventory. Then Maya took 3,000 in goods. We call it goods for own use. So you less it from the purchases. You less it from the purchases and the opening inventory. Then we have, and that's all. So it's going to be one there. Please calculate it for me there. You're going to have, let's have our revenue. Our revenue is 210,000. Okay. 210,000. Are you there, please?
210,000.
Let's do the debit side first before the credit side. Okay. So for the debit side, you have your purchase, your opening inventory, which is 20,000. Let's start with the opening inventory. 20,000.
Okay.
Plus your purchases. Your purchases is 155,000. 155,000, right?
Yes.
Yeah. Then we have our cost of goods sold. Goods withdraw for personal use, which is 3,000 minus 3,000.
Minus 3,000?
Yeah. That gives you 172,000, right?
Yeah.
172,000, right?
Yes.
All right. Then the closing stock, 25,000 minus closing stock, 25,000.
Minus what?
The closing stock, the stock at 31 December 2019, the inventory, 25,000.
So 172,000 minus
147,000 now.
Okay,
147,000. That's the total.
1,000 minus.
Now listen, we have our close. Let's start again. We have our opening inventory 20,000. Opening inventory is 20,000, right? Plus
yes,
the purchase is 155,000. Plus we have now minus we have goods took by Maya 3,000. That's drawings minus the closing inventory 25,000. So the total is 147,000. Okay, you take it away from 210,000, which is your revenue.
210,000.
That's the total sales.
minus 147,000.
Yeah.
63,000.
So that is your gross profit. So the formula for gross profit is sales or revenue minus cost of sales. Okay, cost of sales. That's the formula for gross profit. That's what you get when you are preparing your income statement. Is it clear? All right.
Yes.
So we go to question C. For C, they said we should calculate. So for C, we have the statement of financial position. So we're going to calculate equity, the total equity. Are you there with me?
Yes.
So for our equity, we need to prepare, we use the statement of financial position to prepare equity. So the first equity we have is at the 1st of January 2019. The total equity we have was 68,400. Remember that? We have equity to be 68,400. Okay. Then let's do it this way together. We have equity is 68,400. That's equity at January 1, 68,400. Plus additional equity, we have it here. They said Maya gave a vehicle or motor car, motor vehicle valued at 10,000, right? Here, 10,000.
Yes.
That's additional equity. So you add it with 68,400 plus 10,000 now. That gives us 78,400, right?
78 what?
1,400. That's your 68,400, which is the equity for January. You add it with additional equity, which is 10,000. Here we have, hold on, please. Our equity here.
Yeah.
I'll try to work on something. Equity at 1 January 2019 was 68,400. That's what we got, right? Okay. So you add it. Save. So you had it now. This is 8,400. You add it to the 10,000 here. There's 10,000 here, right?
Yes.
So you had it with 68,400. So our total equity becomes. So our total equity becomes 78,400. Are you with me?
Yeah, right. 78,400.
Okay, so 78,400. Then you add your profit for the year. The profit for the year was 10% of 210,000 based on what we read here. It said profit for the year as a percentage of revenue was 10%. 10% of revenue, 210,000. Revenue is 210,000 here, right? So 10% of it is the profit made by Maya. Are you with me?
Yes.
So 10% of 210,000 is 21,000. So you had 21,000.
So I add 21,000 to the 78,000.
So it gives you 99,400. 78,400.
Plus.
Yeah, right?
Yeah.
So that's 99,400. Then we go back to the information. Based on the information here, we have, they said Maya took goods, $3,000, and cash, 15,150 for personal use from the business. So you add this together, you take it away from the value we have. So 15,150 plus 3,000 gives us 18,150, right? So 18,150 minus this, minus 18,150. So that's our total equity for the year. That's 81,250.
81.
81,250.
81,000.
250. That's our total equity. All right. How do you get your total equity? Your total equity is the equity you get for the year, plus any additional equity you have, plus the profit of the year, less whatever drawings you have. Then you have your total equity.
This is kind of complicated.
Don't worry, I have it written. So you're gonna, as soon as you get it, you're gonna understand.
Okay, good.
All right. So go to question D. They said, state two factors that cause non-current assets to depreciate. This is depreciation. And when we talk about depreciation, when we talk about non-current assets are assets that can stay with the business for a very long period of time, more than a year. Like land, like machinery, like building, like equipment, like motor vehicle. They can stay for more than a year, yes or no?
Yes.
Great. So these are considered as non-current assets. So the question is saying, what are the causes of depreciation for non-current assets? Why will non-current assets depreciate, lose their value? They can lose their value based on the passage of time. Because over the years, the non-current assets will start depreciating. So the first factor is the passage of time.
Yes, I have.
You get my point?
Yeah, I've taken it before, I think.
Yeah, passage of time means with time, the value of assets starts declining or diminishing. Another factor is wear and tear. In the course of using it, it will never be the same as when you bought it.
It will get old.
It will get old, yeah. So that's another factor. Is it clear?
Yes, it is.
And another one you could talk about is economic reason. Maybe the situation of the country makes you to sell it at a lower price. Is it clear?
Yes.
All right. The next question, question 1E. Are you there?
Yes.
Yeah, they said, state two concepts that apply when depreciating non-current assets. When talking about concepts, we are talking about accounting concepts. And accounting concepts we have accrual matching concept, we have consistency. These are different accounting concepts we have. So whatever accounting concept we have to use, they are all accounting concepts that could work for depreciation. So we can talk about accrual concept, then consistency concept. Accrual concept, consistency concept. These are concepts that we use when we are depreciating a non-current asset. Is it clear? All right.
Yes.
Then we go to 1F1. 1F1, right? All right. Yeah, the first question says, they say set the formula for each ratio. So for current ratio, current working capital is the same as current ratio. The formula is current assets minus divided by current liabilities. Current
What's ratio?
Yeah, current ratio. This one. Current ratios. It's current assets divided by current liabilities. That's current ratios. Is it clear? Then for acid test ratio, the formula is current assets minus inventory divided by current liabilities. That's the formula for that. Is it clear?
What's the numbers on the side?
These are the ratios
2019.
that they've gotten based on the information, the items. I will explain them now. We're going to need them. Is this one clear? Is it clear, please?
I don't. Yeah, it is, but I don't get why their numbers are there. Like, what type of numbers?
These numbers now, when you check your inventory, when you check through your inventory, the inventory is here. Wait, the items you have here.
Yes.
Okay, let me just show you this one now. These are current. This is inventory. This is an inventory. Current assets. We have other receivables is a current asset. Trade receivable is a current asset. When you add this together, you divide it with this information, liabilities, and this, you're going to get the figure. They are giving us this figure for now, just the figure. But the formula to get the figure is what I just gave you now.
Yes, it says formula there.
Yeah, that's the formula I gave to you now. They said write the formula.
Yeah.
They said ratios, write the formula. They gave us this information. This information is default. It's from the question. But what we need to do is to create a formula for the question. So for current asset, it is current asset. For current ratio, it is current asset divided by current liabilities. For liquid ratio, it is current asset minus current asset minus inventory divided by current liabilities. That's just what you need to know. Is it clear?
Yes.
All right. So the next thing is, they said we should evaluate the change in liquidity. So based on this information we have here, are you with me?
Yeah.
First, for liquidity, for current ratio, why do we use current ratio? We use current ratio to understand the financial statement of the business. Shall we continue now? Hello?
You're lagging a little bit. Yeah, it is.
Okay, so they said we should evaluate the change in liquidity. Based on what we have here, liquidity changes from 2018, we have 2:1 to 2019, which is 1.8:1, right? So first, what do we use the current ratio for? We use the current ratio to determine the strength, the financial strength of a business. The financial strength of a business. That is what we use the current ratio for. Therefore, the liquid ratio, we use it to confirm, we use it to measure the total liquidity a business has. Get the difference between current ratio and liquid ratio. Current ratio is used to determine the financial strength of a business. Liquid ratio measures the amount of liquidity a business has. Is it clear?
What's a liquidity?
Liquidity means the ability to turn to cash, the amount of cash available to a business to spend. That is liquidity. Now, the business has the financial capability to spend. That is liquidity. But when you use your liquid ratio, we are talking about the ability you have as a business to be able to pay your short-term debts. Okay, do you get it?
Yeah, I get it.
Okay, so for this liquidity ratio, I wrote liquidity of the business has reduced between 2018 to 2019. Normally, for your current for an ideal current ratio should be 2:1. An ideal current ratio should be 2:1. So it means if it is 2:1, like 2018, it means that the business will be able to pay its short-term debts. That is what it means. But going to 1.8, it means that the business is not having enough liquidity. So what could have caused this? It could have meant that the the company has a lot of inventory unsold. You know what inventories are? The stocks, the stocks of the business, what the business is selling. So if the business has a lot of stocks unsold, that means a lot of money is tied down to those stocks. So the company, the business will be having problems about cash. Is it clear?
Yeah, it is.
Okay. I think that's about okay. Question 1 is done. Any question about question 1?
No.
All right. So let me stop question 1 now. Then we do question 2 with another Zoom link. Okay.
Okay.
Yeah.
Okay.
Yeah.